So let's start with some basics on the characteristics of a corporation. Now, as you've learned, we've got different business entity types, from the very small companies that are sole proprietorships. From there, we've got, as companies start to grow, sometimes you'll see partnerships, general partnerships, limited liability companies, S corporations, and then finally, when a company gets fairly large and they're really looking for ways to improve their ability to raise capital, they will often become a C corporation, or what we just call a corporation. For the most part, when you think about just about any large business, you're going to think of a corporation. Corporations that have their stock traded on an open stock exchange, such as the New York Stock Exchange or NASDAQ, those are what we call public corporations or publicly traded companies. Some of the advantages of the corporate form of business: it does substantially increase a company's ability to raise capital, because they can issue stock and sell that to investors and raise large amounts of money that way. It also limits the liability of the owners, as the corporation is essentially a separate legal entity from the owners. The management structure is a little bit different from what you see in a smaller business, because normally in a smaller business, the owners will directly run the organization. This is not the case for a corporation. The corporation will have stockholders who are technically the owners. The stockholders elect the board of directors. The board of directors is then charged with corporate governance, and they are the ones that will appoint officers such as the CEO, CFO, and some of those executive level folks. And then, of course, those are the people that will actually run and manage the business on a day-to-day basis. They'll hire other employees who work for them and follow their lead and their direction. Okay. So, as we said, there are some advantages to the corporation. They are a separate legal entity. They have a continuous life. Okay, so for example, if one stockholder dies, the corporation is not going to dissolve or anything. The corporation is going to continue to operate. Not only can we raise capital easily, but we can also transfer ownership very easily, because stock can be easily bought and sold, and of course limited liability for the owners of the company. The two biggest disadvantages to the corporate form: there is substantial increase in regulatory compliance cost, especially for publicly traded companies. They're going to have to comply with SEC requirements, as the Securities and Exchange Commission. And so there's going to be a lot more things that they have to think about in that regard. Double taxation is often another disadvantage that you hear about. And I always like to provide a little bit of clarity when it comes to double taxation. Here's where double taxation comes in, okay? It is because the corporation pays income tax at an entity level. So at the corporate level, they will pay a corporate income tax. However, if they distribute some of those retained earnings, those retained profits, to their shareholders, these shareholders will then pay individual income tax on the dividends that they've received, in accordance with how dividends are taxed for individuals. So the individual is not paying tax twice, and the company is not paying tax twice, but because the company has already paid taxes on the monies, and then the shareholders will also pay taxes when they receive those monies as dividends, that's where we get the proverbial double taxation. Okay, so let's talk about some basic elements of stockholders' equity. When we look at the stockholders' equity section of a balance sheet, we can break it into two primary pieces. We have contributed capital. Okay, contributed capital is essentially what the investors have contributed to the business. So when we're looking at a balance sheet, some accounts that will normally fall under the category of contributed capital are going to be common stock, preferred stock, and any additional paid-in capital accounts. Sometimes you will see additional paid-in capital shown as APIC. That's just APIC, which is, of course, just an abbreviation for additional paid-in capital. Sometimes you'll also see it listed as excess of par. That is another way of saying paid-in capital. So those are the things that we see under contributed capital. The other category is retained earnings. And retained earnings are essentially a company's accumulated net income and net losses from the inception of the company, less any dividends that have been distributed to shareholders. Now, what you'll actually see for some companies, they may actually carry a negative retained earnings balance. If a company has negative retained earnings, it will typically be listed as an accumulated deficit. Okay. All right. When we're looking at the number of shares of stock, there are typically three numbers that are reported. Oftentimes they're reported on the face of the balance sheet, but if not on the face of the balance sheet, it'll be on the statement of equity. The three figures are authorized, issued, and outstanding. Okay? The big one here is authorized. Okay? This is the number of shares that the company is legally able to issue. Okay, now the amount that they actually issue is normally much smaller. Very few companies actually issue the total amount that they're authorized to issue because they want to leave themselves room to issue more in the future if they want to do that. Okay, so the number of shares issued is the amount that have actually been sold to shareholders. Okay, so authorized is the total amount we could legally issue. Issued is the total number of shares that have been sold to shareholders at some point, so have been issued. Outstanding. Outstanding means the total number of shares currently in the hands of shareholders. Okay, so you think, well, what is the difference between outstanding and issued? Normally, it's going to be two things. It is going to be shares held in treasury. Okay, sometimes we call this treasury stock. Sometimes when a company feels that their stock is undervalued on the open market, the company will actually buy back their own shares. Okay, if they buy back those shares, those are classified as treasury shares or treasury stock, and they are no longer outstanding. Okay, so that is sometimes a difference. And then in theory, companies can also retire stock. You don't see that quite as frequently. But either of those can create a difference between the number of shares issued and the number of shares outstanding. Okay, so here is a very simple example of a stock issuance. Okay, so we're going to assume that a corporation is authorized to issue 10,000 shares of $100 preferred stock and 100,000 shares of $20 par value common stock. They choose to issue 5,000 shares of the preferred stock and 50,000 shares of common stock at par value in exchange for cash. Okay, so in this case, the investors are actually paying the par value for the stock. Okay, so we debit cash for the total received. We are going to debit preferred stock. That's 5,000 shares. Times the $100 because, again, the investors actually paid par value. And the common stock is going to be the 50,000 shares that was issued times the $20 par value of that common stock. Okay, so debit cash and the credit goes to preferred stock and common stock for the respective amounts. Now remember, because these are equity accounts, the credits here increase those accounts. Okay, now let's look at what happens when they issue stock for an amount that exceeds par value. Okay, so in this case, we're looking at a company that issues $2,000 shares of $50 par value preferred stock, but they sell it for $55. Okay, so in this case, the investors are paying a little bit more than the par value. Okay, debit for the total amount still goes to cash. We're going to put the credit to preferred stock based on par value. Okay, that additional $5 that the investors paid, the $5 that exceeded the par value, goes into our additional paid-in capital account. In this case, they're calling it paid-in capital in excess of par. That's where the credit goes. Again, this is another element of contributed capital. It is an equity account, so when we post a credit to paid-in capital in excess of par, it increases the total equity for the company. Okay. Sometimes companies will choose to issue some of their retained earnings to shareholders in the form of a dividend. A dividend is essentially a distribution of earnings to the shareholders. Now, you're going to learn in your reading when a company decides to issue a dividend, we have 3 dates that become important. Okay. The date of declaration. This is the date that the board of directors approves and authorizes the payment of the dividend, and it is the date at which the company has an obligation. Okay, so on the date of declaration, we now have a liability to pay that dividend. Okay, date of record. This essentially determines who is going to receive the dividend. Now, it may seem pretty straightforward. Well, whoever owns the stock gets the dividend, right? But what we have to keep in mind is, especially when we're talking about, publicly traded companies, the shares of stock change hands all the time. People buy and sell stock all the time. And so we need a specific point in time when we say, okay, this is it. This is the point of time. Whoever owned the stock at this particular moment, that is the person who's going to be entitled to receive the dividend. That is the date of record. Okay, so whoever owns it at that specific point of time, that is the person that will be entitled to receive the dividend. And then, of course, the date of payment, that is just the point at which we satisfy the liability by actually paying the dividend to the stockholders that we determined were entitled to receive the dividend based on the date of record. Okay. Sometimes companies will do a stock split. Okay. Now, you may think, well, why in the world would a company want to do a stock split? What is the point? It doesn't bring in any cash or anything like that. Normally, when you will see companies do a stock split is when a company starts to see the market value of their stock becomes so high that they feel like it might actually make the stock a little bit less attractive to potential investors. Okay. In this case, it looks like the stock got up to $100 a share. And they're going to do a 5-for-1 split. So, if you own 4 shares before, now you own 20 shares, but each share is only worth 1/5 of what it was worth. Now, again, $100 probably not a big deal, but if you go out there and look at the stock market, you can find stocks that trade for fairly large amounts, and so again, and sometimes that's fine. But if a company starts to feel like that the market value of their stock is actually to their detriment and it's not attracting investors, this is an easy way to reduce the price of the stock. Okay, so maybe make it more accessible to a larger number of investors by decreasing the per share price without really it's not affecting the financial position of the company, and it's not affecting the financial position of existing shareholders because they still own the same percentage of the company. They just now have a greater number of shares than they had before, trading at a smaller value. So that's the reason that you'll sometimes see companies do a stock split. Okay, now we talked about this a moment ago, treasury stock. This is when a company buys back their own shares off the open market. Okay, so these are shares that have been issued to shareholders, but the company decides to purchase them back. There are a variety of reasons that a company will sometimes purchase back treasury stock. One of the most common reasons is simply that they have extra cash on hand and they feel like their stock is undervalued on the open market. So law of supply and demand, they buy back the stock, and it reduces the amount that's on the market. That may increase the demand for their stock, and it may cause the stock price to go up. It will also potentially increase their earnings per share as there are fewer shares outstanding. So, that's a common reason. Other reasons that companies might purchase treasury stock, they might use treasury stock to fund compensation programs such as stock options or employee stock purchase plans, those types of things. Sometimes they might even, it's not quite as common, but a company could buy back their own stock to try to prevent someone else from buying it and actually taking over the company. So for example, if we know that there is someone out there that is looking to buy out the company, they're trying to gather up the majority of shares, then a company could potentially buy back their own stock just to keep the other party from getting them and getting a substantial ownership level. So again, there's a variety of reasons, but essentially it's when a company buys back their own stock. Now, treasury stock, you're going to notice here we're debiting treasury stock, and that's probably going to seem a little counterintuitive because you're like, wait, that's a stock account, we should be crediting the stock account. Well, treasury stock is a negative component of equity. Because it's a negative component of equity, meaning it reduces our equity, it actually carries a debit balance. Okay, so when we buy back treasury stock, now it's important to note it is not an asset. Treasury stock is still an equity account. It just carries a negative balance. Okay, so we debit treasury stock and we credit cash for whatever we paid for that stock.